Hi there, Mike Brady with Generosity Wealth Management, a comprehensive financial services firm headquartered right here in Boulder, Colorado. 2018 is behind us. Thank goodness. Forget about it. 2019, let's hope for a very happy and profitable one. I'm going to put up on the screen the unmanaged stock market index, the Dow Jones Industrial Average, the one that you hear about the most on TV. What you're going to see is the first quarter was negative. The second and third quarters were positive, and that's where we wish that the year had ended. But then we had the fourth quarter, and it took it all away. In particular, December, very volatile and very negative month right there in the month of December. Depending on what stock market index you want to look at, you're looking at the -5, -6% for the year. When you get a little bit more non-common ones like the S&P mid cap, the small cap, and you're looking at the Russell 2000, you're looking at the negative double digits, the negative teens, -12, -14, 15, 16. And when you look at the international markets, whether it's Europe, whether it's Pacific, they were negative double digits as well, okay, in the negative teens, depending on what particular country and what particular index. Very few places to hide in 2018. When we look over at the bonds, the unmanaged bond indexes, you're looking at negative as well, negative single digits, -1 or -6, depending percent that you're looking at for that particular area. And that's kind of a unique situation, but with rising interest rates, that's just what happened for 2018. Let's think about it though for 2017. 2017, I sat here 12 months ago and talked with you about 2017. At that point, what I said is, wow, this was an incredibly non-volatile year. I mean, pretty much every week, every month was positive, and it was a banner year. Yay, 2017, but it's not real. Okay, go back 12 months ago and watch that video, and that's what I said. I'm like, this isn't reality, guys. This is a unique situation. That very low volatile, no volatile year, practically, was then followed by an extremely volatile year, which is 2018. So we have these two contrasts, two extremes right next to each other, which should remind us that every year is different. Okay, every year is different. In 2019, it could be someplace in between. Okay, so let's not extrapolate out and say, wow, 2018 was negative and really volatile, so therefore 2019 is going to be negative and really volatile. It just doesn't work that way. There are many variables in the equation that go towards an economy, currency markets, stock markets, bond markets, etc. And anyone on TV or who is filling a headline in the newspaper or magazine that says this is the reason why, the number one reason, or this is the sole reason, is fooling themselves, and they're fooling you, and don't listen to it. There are a number of factors in a multiple trillion dollar economy and world market, and it's simply not as simple as this is the reason. When we are creating a portfolio, when you as an investor are trying to reach your financial goals, it is important that we stack the odds in our favor to the degree that we can. Absolutely nothing is guaranteed in this world. I just want to say that. But what we can do is look at history and say, how can we stack things in our favor, knowing that the future might be different? And I'm going to say that there's three things that we can do. Number one, stay diversified, have the right time frame, and then look at all the things that are around it, surrounding it, all those decisions. Let me break each one of them apart. Number one, stack them in our favor with the time frame. Let's talk about that first. On a daily basis, the market's going to be up or it's going to be down. Okay, that's it. That's a very short time frame. And I don't know on a day-to-day basis any more than you do whether the market's going to be up or it's going to be down. When we look out to a year, we zoom out like a mosaic. We kind of get a little bit more perspective. We step back from the wall and we look at a year. We say, okay, going back 60, 70, 80 years of market data, 3 out of 4 were positive. Okay, 1 out of 4 were negative. And sometimes those negative years were strung together. I mean, I remember in my career, 2000, 2001, and 2002 were 3 negative years right next to each other. Now, I'll tell you that 2004 and 2005 were good years. I know because I was there. Okay, but 2000, 2001, 2002 were negative years. But 3 out of 4 are positive. So when we look at on a yearly basis, well, we're starting to stack things in our favor if what has happened historically was to continue in the future. When we look at 5 years, has there ever been a time horizon where a diversified portfolio of 50% of an unmanaged bond index, 50% of an unmanaged stock index together has lost money? The answer is no. I'm going to put that chart up on the screen. When we look out 5 years, 10 years, 20 years, now historically the odds have been in our favor when we can hit our particular mark. So it's important for us to remember that. The future could be different. I just want to let you know that. Having a diversified portfolio does not guarantee market losses in a declining market. Okay, I just want to say that. But we're looking at the right time horizon for what you're looking at from a client point of view. Diversification, I said that was very important. That is important. When you see on TV people who've lost everything, okay, that makes great news. Oh my gosh, little old lady lost all her money in this particular stock or this particular shopping mall or scheme, etc. That's why it's important to not invest in one individual stock or just a few stocks or a shopping mall or whatever it might be. They make great, spectacular, horrible stories. That's why you avoid them. A diversified market, a diversified portfolio, even when we look back at 2008, the recovery period was 2 to 3 years. Okay, that was the absolute worst that we keep talking about. The Great Recession was 2 to 3 years. And when I explained just a minute or two ago about the 5-year and the 10-year time horizons, that's important to remember. Okay, even in that worst situation, when we kept our eye on the big picture, reaching our financial goals, that's how we were successful. The third thing is, what are all the decisions around it? It doesn't matter if the market is up if you haven't saved enough money. It's that simple. It doesn't matter if the market is up if you're withdrawing too much money. Okay, it's that simple. So you've got to know what your withdrawal rate is and what your deposit rate is, okay, depending on which cycle of life you are in. If you are older, 60, 70, 80, listen, I'm hoping that you still have a long time horizon. Okay? Hopefully you have a time horizon of 5, 10, 20 years, okay, maybe longer, depending on what your age is. Perhaps you're investing the money for not just yourself, but for your heirs. Okay, that's important to remember, that the time horizon has then become a longer time. Okay, so every year is different. I'm not going to sit here and tell you that 2019 is going to be positive or it's going to be negative. I don't know. But what I do know is that I'm a believer in the economy. I'm the believer in the United States, for one thing. And I'm also a believer in a diversified portfolio for the long term is going to be a wonderful thing for the vast majority of people. But only you can really decide whether the time horizon that you have in a portfolio that we've crafted together, we've crafted with your financial advisor. If you're not a client of mine, you should give me a call, is appropriate. Because volatility and risk, in my mind, are two different things. The risk of you not having enough money, you of not saving enough, or you withdrawing money or not reaching your goals, those are risks. A subset of that risk is volatility. And volatility is always going to be there, particularly when we're looking at things from a short term. And short term means days, weeks, even months. But when we start to look at longer, multiple year strings together, string the years together, the volatility starts to tamper down. Because then we can get some perspective of how it fits towards the end goal. Mike Brady, Generosity Wealth Management, 303-747-6455. Give me a call at any time. Bye-bye.